Here's what's coming up on today's show.
So when we look at the S&P 500, kind of a significant index that you see every day if you're watching any of the news conferences of red or green or what's ever happening with it. But the rise in the all-time highs of the S&P 500 have been driven almost solely by about 5 companies.
Welcome to the Income for Life Show. If you're looking for some common sense retirement planning ideas and want to hear how we make the complex financial world simple, then listen up so you can learn how you can stay retired. The Income for Life Show is powered by Folds of Honor, a 501c3 nonprofit organization dedicated to providing educational scholarships to the families of America's fallen and disabled service members. Now, here are your hosts, Matt Nelson and Nick Schilling.
Welcome to the Income for Life Show, powered by Folds of Honor. This is your host, Matt Nelson, along with Nick Schilling, and we are very proud and pleased that you have decided to spend a little bit of your day today listening to the Income for Life Show. We know you have choices on what you listen to, and we appreciate you spending a little bit of time with us, and hopefully you are enjoying the rest of your day, as I'm usually right here at Income for Life with my partner in crime, Mr. Nick Schilling. Nick, how was your day going today?
Doing fantastic, Matt, and thanks. Excited about the content that we got to talk about today.
We have a great show lined up for you today, and if you listened to our podcast a couple of weeks ago, you kind of got a little bit of a hint of what we're going to be discussing today. We're going to be going through our common sense versions, if you would, of what is going on in the markets when it relates to this COVID crisis that we're dealing with. And the content and the information that we're going to have today is hopefully going to be presented in a way that will make sense to everybody that'll be listening. Wouldn't you agree?
I agree, and I hope that as people start to listen to this as a series, there starts to be some fluidity between the content that we're presenting every couple weeks. So there's a consistency in the message and there's a consistency in the learning that they're going to have about what the fundamentals that Income for Life is and how we do what we do. So really excited to kind of continue that message going forward today.
And that's exactly right, Nick. And I appreciate you saying that, because the idea around what we are always going to be talking about is the common sense retirement planning ideas, which go along with the 3 C's of retirement. And if you tuned in to our last show, we discussed in detail the 3 C's of retirement. But before we jump into that, Nick, what I would like to do is I would like to spend a few minutes introducing our new partner that we have with the Income for Life Show, and that is a charity organization that I know that is very fond in both of our hearts. It is Folds of Honor. Folds of Honor is a 501c3 nonprofit organization that provides educational scholarships to children and spouses of U.S. military members that are disabled or killed while in active duty. And that is such a wonderful organization that you can go to incomeforlife.org and you can click on our button to learn more about Folds of Honor and our relationship. But we are just very pleased, very proud, very excited to now be a partner and have a group like Folds of Honor powering the Income for Life Show.
Not only their mission kind of fits with what we try to do every day, Matt, in helping families, but we couldn't be more proud to have their affiliation to support us in what we're trying to do. We have military families in our family tree. I think both of us do.
Sure do.
So we're super excited that we can lend any support to the partnership with Folds of Honor and vice versa. We're super excited that we're from Kansas here. We're located in Kansas here. And I know that the founder and legacy of Folds of Honor, Major Dan Rooney, is from our local area here
Which
too.
is wonderful.
So we have a connection there. And also we think that just the philosophy of what they're trying to do to support families in need, and we try to do the similar thing in retirement planning, so we couldn't be more excited
and
that we have them in the fold.
Sorry to interrupt you there,
No,
Nick.
go on.
The neat thing about Major Dan Rooney, if you're listening today and you're like, who is that?
Yeah.
Google him. Look into learning more about Major Dan Rooney, because Folds of Honor was founded in 2007 by Dan, and he is an F-16 fighter pilot in the Air Force Reserves who served 3 tours of duty in Iraq. Now, we absolutely believe in Dan's mission. We want to support Folds of Honor in any way possible. And we're taking a grassroots way of doing it. We love their mission. We love what they want to do. We love the fact that Dan Rooney is a local guy for us right here in the Midwest.
Correct.
And the entire charity organization that they do, we fully believe in it, and we couldn't be more proud to have a partner like Folds of Honor in the folds with the Income for Life show.
Correct. And it's something that we talk about not only on this show, but with our families that we're supporting in retirement planning, so that they understand the connection that we have and how important it is to us. And then they can go on, do whatever they think they can do to support this great cause.
And you can go right through incomeforlife.org and support that cause. Definitely go and take a look on our webpage about our partnership with Folds of Honor. It is a wonderful opportunity for you to get involved, or at least to learn a little bit more about Folds of Honor, who they are, and what we do. And we could not be more happy to be powered by Folds of Honor here at the Income for Life show. So what we are going to do today on our show today is we're going to really dive into this idea about what are the markets, what are the economy, what are these fluid moving parts, if you would, how those are relating to this COVID crisis and kind of what's going on and everything that is surrounding the uncertainty that comes with retirement planning. Because as you know, Nick, we're big founders of the 3 C's of retirement.
Correct.
And that is very simple. Again, at incomeforlife.org, we have a webpage specifically designed for the 3 C's. And that is your checkbook, your calendar, and your clock. Your checkbook is how much money is in there. The calendar is when is more money coming in. And the clock is how long is that going to last. So with that sort of mentality, along with the 3 C's of retirement, Nick, in correlation with what is happening right now in the world, in the U.S., with the banks, with the markets, whatever you want to call it, what is happening in that sort of a unknown situation, what is going to be coming down the pipe for retirees and Americans in general, and on the global side of things, how is this going to affect moving forward people's retirement? So let's have that conversation here, and we're going to reference a couple of people that everybody has heard of that also believe right where you and I believe, Nick. So let's dive into our thoughts on COVID-19 when it relates to retirement planning moving forward.
Correct. And it's one of those things when we talk about the 3 C's of retirement, that is a foundation that we have in our philosophy of how we need to think about retirement planning, in retirement, and then planning for retirement. What some of the markers are when you're talking about that is everybody has savings, either in retirement plans or what they're doing on the side to be able to then fund these different vehicles that they're going to use to create those income streams. Now, money in the market is such a fickle thing, and we are in truly unprecedented times right now. We've had, because of this pandemic, there was a significant dip in the financial markets in the end of the first quarter, beginning of second quarter of 2020.
March, right? It was
right in the beginning of March and end of March. There was a dip. Now, the markets have recovered. But if we take a step back and start to look at what's underlying the financial markets, so obviously when we start locking up, going into quarantine and social distancing and some of these things, measures that we've taken to stop or mitigate the spread of this pandemic, obviously those actions are going to have ramifications deep within our economy of businesses, unemployment, and many other things that we have yet to feel.
Correct.
As we're doing this planning. Now, with that being said, the markets have rebounded. But why? Somebody can say there's a huge disconnect in what the markets have done since the lows at the end of March and where they are now. And one of the things that Matt and I talk about a lot is when you look at what's happened here, there's been a significant loss of income from people losing jobs, losing retirement savings, being out of work for a significant period of time in the course of 2020. But what has buffered that is there's been a massive injection of $3+ trillion from our government. And when we start to get in, not to get too technical with any of these things, when we start to look at how financial markets react and how they function, They are a forward-looking mechanism. So when we look at that, they're looking every day as to what the market can do today with the information that's available. Now, they are significantly more short-term in their look than the retirees that we're talking to every day. Meaning they're kind of day trading. What's happening this minute, this hour, intraday, not intra-decade.
Well, let me jump in. Let me jump in right there, because that is huge to me and to what is going on in retirement planning now. Because think about it. What does everybody always hear? They always hear, oh, you got to plan for the long term, right? You need to look 10, 15, 20 years down the road. And every time somebody goes and meets with their financial plan or whatever it might be, they're always talking about, oh, you got to look at long term. And sometimes whenever they're giving projections of maybe how the market could perform, they're looking at long-term historicals to say, here's what it did, here's how it's done, things like that. And everybody's planning for the long term. But what is actually happening with, for example, the top 10 investment banks out there? Everybody has heard who those banks are, and they understand that is what drives the market. That is what has the highs and lows and the ebbs and flows of the market.
Day in and day out.
Day in and day out. But the key is it is minute to minute. It is hour to hour. It is day to day, not long term. Correct. Like a lot of people are hoping, I guess, maybe would be the right way of saying it.
And that's exactly it. And that's where the disconnect comes in between what Wall Street is doing, the way they're thinking and how the markets are functioning, and the way retirees, people planning for retirement and are in retirement, need to look at their retirement savings. They are two very distinct things. You can't get caught up into what's happening within the marketplace. And I'll dig in deeper as to a little bit better analysis as to actually what's happening, because it's not as rosy as it looks right now. Even though the markets are touching all-time highs, it's not quite as rosy as it seems, and we're actually in a little bit of a stasis right now. The government has injected a ton of income into the marketplace, which then has caused equity markets to rise. Interest rates have fallen, which is not great for savers and retirees. And right now we're in a holding pattern. We're waiting to see if Congress and the government is going to come up with a second wave of funding and what that second wave is going to look like.
And they're trying, and they can't do it. They're trying to figure out a way to be able to inject more money. And I get all that. I'm not saying that they shouldn't by any means. Something needs to happen here. But the fact that they're squabbling over it bothers me. It bothers a lot of people, because this is something that is bigger than squabbling over something that has nothing to do with the virus. And so they need to get their act together when it comes to that. But what I want to do is I want to read something here to you, Nick, and I want to see how this lands on you. Because like we said early in the beginning of the show, we're going to reference a couple of people that everybody out there has heard of for the most part, and kind of see what they are saying about what is coming, not necessarily where we are right now. It's important to know, obviously, where we are right now, but kind of how this is going to be moving down the road, because come, this last quarter of this year, there's, a lot of this money, that the $3 trillion, that was given out to all these, not only you and I or people, for unemployment or whatever it might be. There was billions and billions of dollars given to big corporations just to help them keep their doors open.
Correct.
And the biggest ones out there that had a very, very distinct timeline are the airlines. And people need to understand that these airlines out there, not only have they been hurting like you wouldn't believe, running some at 5% capacity, but those airlines have a significant role in our economy.
Massive workforce.
And come September 1, that's out the window for a lot of these big airlines. But what I want to do is I want to talk to you a little bit about an article that I just found the other day that was on MarketWatch. And it's from everybody's favorite financial advisor, Warren Buffett, right? The grandpa, the godfather of the markets, right?
The grandfather, the Oracle of Omaha.
The Oracle of Omaha. And the article is titled, Market Timing When Clocks Have No Hands. Warren Buffett's warning is as relevant now as it was in 2000. So what I want to do is I want to read here what Warren is talking about. And he's using the idea of Cinderella turning, the pumpkin, all those things. So whenever I'm reading this, just kind of understand where Warren is coming from whenever he's talking about this. But this is directly from Warren Buffett. He says, they know that overstaying the festivities, that is, continuing to speculate in companies that have gigantic valuations relative to the cash they are likely to generate in the future, will eventually bring on pumpkins and mice. But they nevertheless hate to miss a single minute of what is one hell of a party. Therefore, the giddy participants all plan to leave just seconds before midnight. There's a problem, though. They are dancing in a room in which the clocks have no hands. So what Warren is saying, Nick, is in essence exactly what you and I were just talking about, is these groups are looking for immediate gratification.
Correct.
And Warren is looking at this for, they don't realize that nobody knows how this is really going to land on anybody. They're dancing to clocks that have no hands, which means they don't know the timing. They don't know what's happening, but it all could get bad. So what I want to do, Nick, is have you just take a look at that and kind of give me your thoughts on what Warren Buffett is saying about this particular situation.
I think Warren's giving a nice, colorful story as to some of the things that we're talking about, not only today, but with our clients, as what this disconnect in the markets are looking. People are looking at, we're touching all-time highs, but what does that actually mean? A lot of the foundational aspects of our economy are at significant crisis right now, from a manufacturing, retail, trade, some of the stabilizing forces of oil prices, airlines, things like that are at places of 40 plus 50 million people filing for unemployment. That stuff has to come to bear at some time. So what I want to give is a little bit of substance around what's causing the markets to touch all-time highs now, and then maybe back into why Warren's saying some of those pumpkins could start to rot at some time.
You're exactly
when
right.
the fundamentals start to catch up, because there's going to have to be a balancing of that. So when we look at the S&P 500, kind of a significant index that you see every day if you're watching any of the news conferences of red or green or what's ever happening with it. But the rise in the all-time highs of the S&P 500 have been driven almost solely by about 5 companies.
Now think about that. Let me stop you right there, because this is important for what you're about to discuss.
Yep.
There are 500 companies
Yes.
in the S&P 500.
Correct.
Right? Those 500 companies have various sectors in them. Right?
Yeah, 11 sectors.
11 sectors. And the goal, the idea, the whole go of the S&P 500 is diversification, right? You have some companies that do good at times, other companies not so good. But the idea is, if you're investing into the S&P 500, the goal is having a whole bunch of companies all working at the same time. That way, if there is any movement with one or two of them, it's not going to affect you, because you got 498 others that are maybe doing well. And the goal is kind of a calming, low volatility, really be able to have an investment into 500 companies.
Correct.
That's the S&P 500. But what you just said, Nick, which you're going to elaborate on next, is you are telling us that the S&P 500's go right now, the S&P 500's gain, go, momentum, whatever you want to call it, is based around only 5 of the 500 S&P companies.
Yeah, the main thrust of what's happening, you look at an S&P 500 index as an overall representation of the fundamental economy that is the domestic U.S. economic outlook. But unfortunately, in the COVID age of these things, it's really been driven. These all-time highs are being reached by about 5 companies that are tech first, kind of COVID resilient, that have risen exorbitantly, very, very quickly. And the other 495 companies have not done near as well. So if you're looking at Apple, Amazon, Microsoft, Google, or Alphabet, as they're known at their parent company, and Facebook, those 5 companies have increased their market cap so significantly as the rise from the bottom in March of this thing to where they are right now that they've caused the entire S&P 500 to reach all-time highs. So to give another substance there, over 60% of the S&P 500 companies have a lower market capitalization than they did at the end of 2019.
Think about that.
So 60% of the companies are in a worse position
Think about
than they were at the end of last year. Those 5 companies have risen so significantly that they've literally buoyed everything else that's happening in our economy. If we take out those 5 companies from the S&P 500 index, which is up about 5% depending intraday stuff, the S&P 500 would be down about 3%.
So think about this. So those top 5 companies, give everybody those companies again, Nick. We got Google,
or Apple as Alphabet as they're called. Apple,
Facebook,
Amazon, Microsoft, and Facebook.
So you have those 5 tech companies.
Correct.
Out of the 500 S&P 500 companies.
Yep.
And those 5 are, I don't want to use the word propping up the S&P 500, but that's just kind of an easier way to understand it. But those 5 are driving the S&P 500 almost entirely by themselves, because the other companies that are in the S&P 500, they're stagnant maybe, they're down,
Yep.
they have not shown the big gain potential by any means.
They haven't responded because of many factors to this overall rise in equities that we're seeing that's touching these all-time highs. So fundamentally, a lot of these other sectors, we call the S&P 500 is broken up into 11 sectors. You got real estate, materials, utilities, and energy. All of those have not responded anywhere near what those 5 companies are. So to give another stat here real quick, those 5 companies individually, so again, Apple, Amazon, Microsoft, Alphabet / Google, and Facebook, are bigger. Their market capitalization individually. So Apple is individually bigger than the entire real estate market within the S&P 500.
Okay.
They are bigger than the entire materials and utilities market in the S&P 500. So the balance that you want in the diversified look at the economy that the S&P 500 index wants it to be is not as balanced as it needs to be right now for a long-term view of retirement planning.
I want you to take a minute, if you would, because I want people to really do their best to understand what you just said. The sectors, the 11 sectors.
Yes.
You just stated that just one of these 5 that we are talking about here that are in essence driving the S&P 500, one of these 5 is bigger than an entire sector or sectors of which is a combination of the other 495. One company
Correct.
is bigger than entire sectors, which constitutes multiple
Correct.
companies. So when you hear that, okay, I get it. And we are in a tech-driven world, right? And you got the Facebooks that are all over the world and the Googles and all of this. I get that. What would happen if the government comes in, for example? I know they've been trying to do this for quite some time, but they jump in and they try to regulate Facebook, right? Or they have Mark Zuckerberg in front of Congress talking about ways where they can try to put regulations or maybe do something to curb these companies a little bit. If that were to happen, and I know this is all speculative. I know we don't have a crystal ball. We're sitting here in front of a couple of microphones and we don't predict the future here. But again, if you've listened to Income for Life show often, if it looks like a duck, it talks like a duck, we're going to call it a duck. If something were to happen with one, pick one, I don't care, one of those companies, what sort of an effect would that have on the S&P 500 as a whole?
Well, obviously it would be pure speculation, but those are the companies that are driving this rebound that we've seen. And basically that is speaking to exactly what Warren Buffett was just talking about, that some of these pumpkins that have seen exorbitant rise in their market capitalization or price to earnings ratio may be saying that not that Apple's not a good investment or Amazon's not a good investment. That would be dependent upon what your goals, needs, and objectives are. But what it's showing is there is not as rosy a picture of the overall economic viewpoint domestically in the United States as some of these companies are driving. These are going to be the drivers and major levers of our economy going forward because it's kind of where our society's at. A lot of people are on Facebook. Billions of people are on Facebook. A lot of people are using Amazon to get their groceries and buy things. So these companies, we're not saying they're unstable. We're saying that it's out of balance when you look at how we're looking at investing for the long term.
Which is where people's retirement should be.
For retirement planning. Right. So don't get caught up as much in the shiny, glossy of where we see market valuations at right now. We need to start looking at where we think the underlying economy is when we start looking long-term investing, long-term income planning, and how we're going to set clients up to be able to withstand maybe some upcoming volatility because we got who knows what's going to happen with a new package to help with this coronavirus pandemic. Who knows what's going to happen in the upcoming election? And then there's a lot of uncertainty as to how we're actually going to not rebound market-wise, but rebound economically. Get back into manufacturing. Get back into trade. How are the airlines going to respond? How are these workers going to get back into the workforce? Retail, just going out to eat every day. How are these things going to start to respond that are fundamental aspects of the way we live our life every day?
And there's so much different. The difference between the markets
Correct.
and economy.
Correct.
You know, a lot of people kind of blend those all together. They couldn't be more different. I mean, because everybody understands, okay, the markets, you look at the numbers, you talk about the red and the green, you see them on CNN or Market Watch or whatever all the time. But we've just determined that the drivers of that are extremely limited in numbers compared to maybe the way it used to be. And now we got the Fed that is pumping in money. Where's that money coming from? You know, a lot of people are concerned, okay, they dumped in $3 trillion or $6 trillion. They're trying to do another $2 to $3 trillion. With current bank rates already at an all-time low and the Federal Reserve has already been hurting for the last, 6, 7, 8 years, the bank rates have been awful. So where is this money coming from? And in this article that Warren Buffett is talking about, again, that is on Market Watch. You can, of course, go download it and read it anytime you want. It's just literally from the other day. But in this article, they state, today's investor knows a thing or two about effortless money, right? As the disconnect between the market highs and the reality of the devastated economy has never been more pronounced, thanks in large part to the Federal Reserve's commitment to pumping cash into the system. So that talks right into where you and I were just talking about, Nick, is because we have all this money that is going into the system, right? The system is your unemployment check, right? It's keeping a business afloat, whatever it might be. But the entire process, it just feels like to me this is putting a Band-Aid on a gunshot wound. It feels like that they're putting money into a system. And then maybe this is going to be my little conspiracy theory mentality here. Nick and I have talked about it multiple times. I'm a simple creature. So I'm sitting here listening to this, and I'm like, is this just stalling? Are they delaying the inevitable to get through November? Because we got an election coming up. Is this process strictly geared around stalling, waiting, keeping people pacified, whatever the scenario might be, until after the election, and then the election results, whichever way it goes, could be blamed or whatever it might be. So whenever the corrections do happen, then they can say it was because of this or it was because of that, when really this whole thing was kind of put in place a while back. So talk about that a little bit, because if I'm just listening to this driving down the road, I'm like, okay, my bank rates are awful. I don't like to have money in the bank because the rates have been so bad for so long. The volatility is really high in the markets right now. This COVID is stripping people's livelihoods because they're not able to work anymore. All of these things are coming to a grinding halt, yet the markets are up. It's like, what is going on with this?
It's one of those things, Matt, and you and I have talked about it, and the last thing we want to do on this podcast is get political. But unfortunately, politics are kind of driving what we're seeing in the markets and what our economy and is going to happen within our economy. So we do have to kind of touch on what is right now and then also what could be in the future. So yes, right now, basically the markets are solely responding to what the government is injecting. So technically, if we're looking at it, our financial markets, as independent and as, in quotes, capitalistic as they are by their nature, are pretty socialist right now in their viewpoint, because the only thing that's driving the markets is the injection of capital from our government. Now, what's going to happen with the next phase of this, if we're going to get it, I think is going to really dictate how we're going to respond from this and overcome it, not market-wise, but economically. If they can structure a package that can help put money in the right places, that can drive the right incentives, getting people back into work, getting people saving for retirement, earning their income, people being able to go to restaurants and fund some of these lagging industries that the U.S. has needed for some time, that are the foundation of what we do every day, is going to help bring the economy into better balance with what the market is showing right now. One of those two things has to happen. Either the market's going to come down to meet where the economy's at, or the economy's going to rise up a little bit and start to touch where the markets are showing everything can be. And the thing that's going to drive that is the structure of what the government's going to come up with to help us get past this through November, no matter who's the president, and be able to rise and continue to go with what we're seeing in the marketplace right now. But to tie this all together, the markets do what the markets are going to do, and they're driven by Wall Street, not retirees. Retirees have long-term savings that they need to utilize, not just invest in the marketplace. So the things that we talk about every day need to start to structure of how you can use those saved assets to create long-term income streams.
Correct.
In your retirement planning. And we think everything is long-term, and we talk about everything being long-term, but there are points in time where people need to start looking at what the environment is telling them and start to make decisions to say, now is maybe a time for me to start locking up certain things, taking advantage of where the marketplace is right now, and start to guarantee what they can guarantee. Start to take control of what they can control and not leave it up to things on the outside that they can't dictate, that we don't know.
And we talk about this all the time on our shows, Nick. We are firm believers of, when it comes to proper retirement planning, it comes down to guaranteed lifetime income. That is 100% where the primary focus needs to be, because as you know, and we talk about all the time, retirement is not about how much you have in assets. And we talk about this all the time because assets can be lost. A lot of different ways an asset could be lost. It could be a death, it could be a divorce, it could be a market fluctuation, it could be a medical event. A lot of these different ways that an asset can be lost. So in retirement, the proper equation, if you would, the proper way to think about it is how much guaranteed income can those assets produce? So that is the key.
That's exactly it.
It is literally what we call all the time, we call it the retirement shift. It's when you're shifting mentally from accumulate, market, over to preservation and distribution. And that's a tough mental aspect to come to with a lot of our clients, and we walk you through that, and we help you do that, and we show you how that works. However, what I want to talk about real quick is, we said earlier in the show, we have a couple of national people that believe the same that Nick and I believe, and they believe that the Wall Street numbers are propped up by the top 5 of these companies, and it's not all rosy like, some people will like to make you think when it comes to the market valuations and things like that. So the next person that I want to reference here for everybody that you very well may know who this person is, it's CNBC's Jim Cramer. Jim Cramer, he's the mad money guy. If you've ever watched CNBC, he's the loud guy that shakes his fists and talks about, markets and all this stuff. Nick, you know Jim very well.
He's a character.
He is.
But he has some fundamentals to what he's thinking and what he's saying.
He's an incredible character. There's a lot of showmanship in what he does, but the thoughts and the back end of what he is talking about, a majority of the times we agree with. And this is a perfect example. Again, this is an article from earlier this month, back on August 19th. And the title of this is, again, it's on MarketWatch. You can go find it. It says, "A Tale Told by an Idiot. CNBC's Jim Cramer urges investors not to be fooled by new highs in the stock market." And what Jim discusses in here, and he says the S&P's new highs are a tale told by an idiot, full of sound and fury, signifying nothing about the hardship of millions of people on food stamps or the millions about to be fired from service jobs or the homeless or the people who are just huddled at home waiting for the vaccine. So when you think about this, and Jim even goes into a little bit more detail about this, he says we had a magnificent V-shaped recovery in the stock market, but the market's not a great reflection of the broader economy anymore, which is exactly what you were
we've been
just
saying.
talking about. And Jim even says, quote, "You don't need to be a rocket scientist to figure this out. Just look at the stocks that have brought us to these levels. They're not in recovery plays. In fact, they are the opposite. They are stocks that tend to do well because of what we call secular considerations." Think about this. He talks right about, in this article, he says Apple, Amazon, Microsoft, Facebook. He's talking about these right here, exactly as you and I are talking about. So as we are trying to get people to understand that this market valuation in correlation to the economy cannot be more different. So Jim Cramer sees it. Warren Buffett sees it. We see it. What we're trying to do is get people to understand this in a way that makes sense. And that's tough.
And really so that they can make better decisions for themselves. Lots of times, as we're seeing the market go up, and we're seeing it probably through rose-colored glasses, looking at, well, maybe this pandemic didn't have as drastic an effect on our economy as we think, because the market's touching all-time highs. Maybe we can just get back to where we were in January and February of 2020, and come 2021, we'll just be rolling when more of these people come back to work. And what these experts are saying, and what a lot of other people on Wall Street and beyond are saying, is there's increased volatility to come. What you're seeing is not necessary reality when it comes to the thing that drives financial markets for the long term. That's a short-term view of a V-shaped recovery driven by a small sector of companies.
Think about that. Now let's project this into the mind of a 62-year-old person that is close to retirement, or even 67 that is in retirement, whatever
Correct.
the scenario might be, which are the people we are trying to help. And let's say that those people have that 401k.
Correct.
Right? Or they got that brokerage account or whatever. They have monies that they have earmarked for retirement that are directly invested into the market. So what they are seeing right now, just on face values, they see a little bit of an uptick in the market.
Their
right?
account's back to where it was before any of this stuff happened in most circumstances.
Most circumstances, they're back to where it was in February, right?
Correct.
So they see this and they're like, okay, well, this is okay.
We
back.
weathered it. Yep.
We weathered it. It's back. And what we are trying to get people to understand is that not only is it not back, there could be some pretty serious turmoil on its way. And every sign, every signal, every intuition, when you see the numbers, reflects that.
Yes. Increased volatility is going to come, especially for retirees and savers. Interest rates are historically low, have never been in the place where they are right now. So that doesn't bode well for people that like to have their money in the bank, earning CDs, and then using that money to live off of. You're going to eat into that retirement plan really, really quickly. And when you're looking forward and saying, not only the U.S. domestic market isn't where it's at, represented in the market, but globally as well. We are a global overall structure right now from an economic standpoint, and the EU, China, and anywhere else on the globe is feeling these economic ramifications that we've felt from this coronavirus, from quarantining, and a lot of the actions that were needed to be able to be taken to stem and mitigate some of this stuff. What we need to start looking at is, well, if we know that volatility is going to increase, that we start to rebalance this overall economic view, what can retirement planners and what can retirees do right now to start to take control of what they can control? Start to set that plan up so that no matter what happens in the future, they've set up their retirement lifestyle so that they feel comfortable going forward. And that's what we want to talk to people every day.
Which is exactly what we do.
Correct.
Every single day.
The last thing we want them to do is get kind of eased into that everything is the way that it is in the marketplace and things are just going to keep going. So I can kind of wait on my plan and see where things go. We think that when the economy does catch up, when all of a sudden these ramifications do come to roost, that it's going to be a pretty sharp decline from where it was before. And the last thing we want people to do is to feel that pain in their retirement plan.
And think about that, because the pain in retirement is much different than the pain while you're working. Correct. When you're talking about your accounts and the values and everything. Because when you're in retirement, you no longer have a paycheck coming in, so you're living off of your savings.
Correct.
You have your Social Security, and then you have whatever else you have.
Correct.
So that brings me to a quick story from one of my clients, because I'll just never forget it, and it absolutely applies right now, especially in this high volatility environment that we're in. Had one of my clients that called me up on a weekend and said, "Matt, you've been seeing what's going on with all this, right?" And I'm like, "Yeah, I know." And they said, "I wanted to give you a call today because this is the first time in my adult life that I could watch the news for the entertainment. And it's all because of you guys at Income for Life. We are set. We are secure. We have a guaranteed income. We are guaranteed against any market losses. We are completely fine. But we are also in a position that if this craziness does recover, we're in a position to get some gains that are going to be better than what the banks are going to give me anyway." So the fact that this person called me on a weekend and said, "I can finally breathe. I can finally just take that that you and I talk about all the time, Nick, just the calmness of being able to say, I'm fine."
To know that their plan in retirement can be executed no matter what happens in the market. No matter what happens, their lifestyle is going to be able to be met. And that is a comfort that most people are searching for. They just don't know how to execute it. They're maybe not talking to the right people. So that's what we try to focus on, not only on this podcast, is giving a representation of where your mind needs to be, where you need to focus on in order to not get washed away by what's happening on the TV all day long.
And most of our clients that do come to us, Nick, we do have some that are talking strictly about how much can I earn, right?
Yep.
I want something that, what's the best interest rate I can get? But a majority, when I say majority, high 95% of the time when people come to us, they're not concerned about, hey, I just want to make sure I can get the highest interest rate I can get. They say things like, I need to have a guaranteed income stream that I cannot outlive so that I won't be a burden on my family.
Correct.
That is what we hear is, I need this money that I've been accumulating for 30, 40 years of my working life. I need this now into a type of a pension style income that I cannot outlive so that I am not a burden and I have a guaranteed income stream no matter what happens. So that is what we do here at Income for Life. And what we're talking about here with the markets and how we think things are going to happen with the markets and the economy have an incredible factor in the comfort and calmness of every single retiree across the country.
And that's exactly it, Matt. Markets can shift so quickly. The last thing we want is your emotions in retirement to be tied to the balance you have on some brokerage account or what the market is green or red today. Not that you can't watch it, not that you can't be interested in it, but we want you to feel comfortable in your plan. We want you to feel comfortable in your lifestyle, that you can live the lifestyle you want in retirement no matter what the market is doing. And it takes a purposeful plan to be able to execute that. And that's what we want to talk to people about. We don't want knee-jerk decisions in retirement. We don't want people getting emotional and making a rational or irrational decision in retirement because of what they see on the news that day.
Correct. That cannot be a better way to wrap up this podcast that we have here on the Income for Life show, powered again by our partners at Folds of Honor, which are incredible, incredible people. As we move forward with the Income for Life show, we just want everybody to understand that there's going to be some times we're going to be talking financial. There's going to be some times we're going to be talking about what's going on locally here in the Midwest, here in the Kansas City area. We might be talking about our, again, world champion Kansas City Chiefs with our future Hall of Famer, Pat Mahomes. So, of course, what we're going to do is every single day and every single time we do a show, we're always going to let Mr. Mahomes know that he's always welcome on our show. Wouldn't you?
Anytime.
Wouldn't you agree? I
Anytime.
mean, he couldn't make it today. We apologize.
Yeah.
We had to bump Pat.
Yeah.
Because we had too many things. So we apologize to Pat Mahomes. We just couldn't fit you in today. But moving forward, we'll see what we can do on the next show.
Correct.
Thank you all very much for listening to us today on the Income for Life show. This is Matt and Nick. We appreciate you listening today. Definitely visit incomeforlife.org. We're also on every single one of the podcast apps with Apple, Spotify, Stitcher, Google. You can search us and find us through any one of those. So if you are the type of a person that wants common sense retirement planning ideas in a way that makes sense to you, then we are the place that you need to take a listen to. Thank you very much for listening in today. Enjoy the rest of your day today, and we will be back with you very soon.
Thanks for listening to the Income for Life show. If you have any questions about something we talked about today or want to get in touch with the Income for Life team, just give a call to 833-450-3068. That's 833-450-3068. You can also go online to incomeforlife.org and check the description of today's show for any relevant resources and contact information. You can also find the podcast on all major podcasting apps, including Apple Podcasts, Spotify, Google Podcasts, Stitcher, and many more locations. The Income for Life show is powered by Folds of Honor, a 501c3 nonprofit organization dedicated to providing educational scholarships to the families of America's fallen and disabled service members. For more information, visit foldsofhonor.org. Information provided on today's show is for informational purposes only and does not constitute investment, tax, or legal advice. Information is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified professional before taking any action.